The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The momentum guys running out of breath and the stock market rally coming to a pause. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Pretty quiet out there, I gotta say.
Yeah, that's a finer point.
Volume really light as well, but we're all really waiting until Friday in Jackson Hole. But that rally that we've seen over the last 8 days really taking a break, and it's a broad-based taking of a break, right? The S&P is barely negative, but the equal-weighted index that made an all-time high yesterday, now down 0.3%. NASDAQ 100 pretty much flat. Russell 2000 underperforming, down 1%. Romaine, all of this to show you is it's a broad-based taking a break.
Yeah, a broad-based taking a break. Is it a halt? Is it a break? Is it a pause? Well, the momentum traders right now and a surge in corporate buybacks that really was supposed to continue driving the U.S. stock rally for at least 4 weeks through this season. That is what Goldman tactical strategist Scott Rubner had laid out, and maybe that still ends up being the case. But for today, that momentum has definitely faded. 8 days of gains right now for global stocks in jeopardy as low volume, high valuations, and few catalysts leaving investors, if not exhausted, certainly not enthused. The dollar also slumping here on this day, a third day of declines as daily momentum gauges there remain bearish. The Bloomberg Dollar Spot Index now on pace for its worst month of the year. And options traders, they're actually positioning for further losses amid those bets that Jay Powell will reinforce the case for rate cuts at that big Jackson Hole speech on Friday. Ultimately, though, this still does boil down to the economic data and more specifically labor market data. Data already viewed as weak, data that could get weaker, at least in hindsight. That's because once a year, the federal government revises past data to better sync it with state-level records, and a preliminary revision that may show payrolls growth in the year through March was at least 600,000 jobs weaker than estimated, reigniting a lot of debate out there over whether the labor slowdown risks a more abrupt downturn in the economy. That's easy for you to say, Alex, but I think you get the point.
Yeah, and also then does it show that the Fed is even more behind the curve than maybe we thought? And we saw that jobs reaction just a couple weeks ago. This is just a different way of looking at what we're seeing in the market here. This is the NASDAQ 100, and we had a solid 8 days of gains. You can see here sort of the volume and the move into the NASDAQ 100. You can really see it here as well. It was the best winning streak that we saw since November of 2023. NVIDIA, for example, rallied like 25% in 6 days. But now we're just taking a break. And Romaine, you really raised that question. Is it a break? Is it a pause? Or is it a buy the dip kind of opportunity?
Well, let's pose that first question to our first guest as we kick you off to the close here on this Tuesday afternoon. David Bahnsen joining us here in Studio 2, the Chief Investment Officer over at the Bahnsen Group. All right, David, I mean, that really is the question here. I mean, this has been a phenomenal rally by any sort of historical standard. And I think a lot of people look at it and they wonder how much gas is really left in the tank. What is a catalyst, if you see any at all, that keeps us going?
For the overall market, I think the best possibility of catalyst is overvalued stuff getting more overvalued. And I think that's problematic as a catalyst. Yeah. There is news that is already known. Okay, rate cuts are coming. Perhaps certain election results excite parts of the market. There's all kinds of things that are already on the table. Is it not priced in? Is double-digit earnings growth next year not priced in? Because, as a matter of fact, 13% earnings growth at a 22 times multiple is already priced in. Both of those things strike me as problematic. We may not get 13%, 22 times can't hold. Yeah. So I think there's a lot of issues there when you're talking about top-heavy, tech-dependent.
Right. Well, let's talk about the top-heaviness of that, because that is the risk, right? That if something does go wrong, then everything is going to go wrong with it. Despite all the talk about the broadening of this rally, this is still a market still highly concentrated in tech. So if you take the infotech sector in the S&P 500, that's like 30% of the S&P right now. You throw in the other tech sectors, I forgot what else, communication
services is another 10.
You're getting close to 50%.
Yeah, that's right.
Yeah.
I think it's very different than what happened in 2000, but I don't know that I agree that everything has to drop if the big tech stuff drops. Cap-weighted indices will because of math, but this is a big difference from 2000 when the NASDAQ dropped that way. The Dow was up that year. Large cap value is up double digits. I saw it myself within our dividend growth portfolio. We weren't down when all these things were getting hammered about a month ago. I do think some of the defensive sectors of the market are very likely to go the other way, zig when the market zags. And so you really are kind of seeing right now a very, shall we say, up and down market that is range bound, but it doesn't feel that way. People think they're doing real real well. The NASDAQ's up about 3% per year for the last 3 years.
So I guess it's a twofold question based on that. One is sort of what is the sensitivity to the broader index to, say, the data now, after sort of what we got in the jobs number earlier in August, and then how you take advantage of that?
Well, that's a great question, because I think that was what the yen carry trade convoluted in our discussion in early August, was how much of it was about economic fundamentals versus a sort of technical and levered unwind that had to take place. If the economic fundamentals were to go negative, you have to think it brings multiples down and earnings down. You can't have economic slowdown without it coming into corporate profits. Right now, we're assuming very good corporate profits and a good valuation on that, which presupposes ongoing healthy economic activity. Now, what you've seen since then is the market saying, okay, maybe we weren't as concerned as we thought we were, that the jobs numbers won't be so bad and so forth. It's not clear to anybody. But I don't think it's been clear for over a year. The jobs numbers have mostly been good. Manufacturing hasn't. Industrial production hasn't. To me, it's a very ambiguous environment for economic data.
So then if we just go to the technical part of it, right? Citi had a note out today that talked about how the dollar is now the funding currency and the carry trade's alive and well, just in a different kind of currency, which leads me to believe there's just so much more technical nonsense out there still.
Well, that's true, but when they talk about it that way, there's no way they could believe that people are going to borrow heavily when you actually have a normalized, a 4% borrowing cost is not going to get you a lot of embedded leverage, which is good. I don't want that kind of excess. That's just distortive the other way. But it's funny. I said this to clients yesterday. The dollar got hit when the market was down big at the beginning of August. The dollar got hit again, and the market has come way up. So one of the most tired things I've ever heard is people blaming a strong dollar on tough market or a weak dollar on a tough market. It's always one or the other, but of course it can't be both, other than a particular economic reason. I'm not clear what that reason is. The dollar matters for emerging market investors. It matters for commodity investors. But for a U.S. diversified investor, there's just certain companies that benefit from a slightly stronger dollar and certain that benefit from a slightly weaker. It's when you get a dramatic move one way or the other that speaks to an economic inefficiency.
Do you see any potential for a dramatic move? I mean, a lot of people look at this recent weakness in the dollar and they point to the shift in expectations on rates. So I'm wondering if those expectations shift even further or more dramatically, if you will, what does that mean for the dollar?
It would require a surprise. Yes. And I don't think that you're going to get a surprise.
And we're definitely not get one on Friday.
No, certainly not. The Fed has not been in the business of surprising markets much about rates. Now, not
intentionally.
No, but 75 basis point increases in a row a year and a half ago, that surprised markets. But no, I think they're going to telegraph every rate cut they do. And I think they will more or less now be following the futures market.
All right, David, great stuff. David Bahnsen kicking us off to the close, Chief Investment Officer over at the Bahnsen Group, as we continue our coverage here on the close, taking a closer look at shares of Paramount and another name throwing his hat in the ring, bidding for that company and Skydance, the heir to the Seagram Spirits fortune, offering a deal that quashes the existing offer from Skydance Media, or does it?
All right, shares of Eli Lilly also getting a booster shot on even more good Zepbound news, why the pharma giant thinks the weight loss drug could have potential for treating a different condition. And another setback to Boeing's effort to certify its largest jetliner, why the aerospace giant is pausing test flights of its 777X, a grounding that could push already delayed deliveries out into 2026. All that and more coming up in just a bit. This is The Close on Bloomberg.
This week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments,
Vice President Kamala Harris closing the gap with Donald Trump,
and informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all week on Bloomberg Television.
One stock to watch is Paramount, down by about 1.2% after another bid emerges for national amusements. Edgar Bronfman Jr., heir to spirits company Seagram, submitting a $4.3 billion bid and will invest in additional money into Paramount itself, including $1.5 billion to reduce debt. Joining us now is Bloomberg's Chris Palmeri. Chris, is this better than the Skydance deal? How do we even know?
Well, the numbers are a little fuzzy, but I think the stock market's reaction sort of tells you something there. The investors were expecting something dramatically better than what Skydance is offering, and these numbers don't seem bigger, certainly.
What do you think the path of least resistance is? Like, is Skydance going to change its bid, or what do you think is going to play out?
I think, we'll probably hear tomorrow that the board of Paramount is going to extend by another 15 days this period when they can consider other bids. And they'll probably give the Bronfman bid, obviously, more consideration. Bronfman's already suggested he's going to up the number a bit. The number we heard yesterday was $4.3 billion, and he's raised $5.5 billion. So we probably will see some more money devoted to, say, buying back Paramount shares. But it's still a much smaller number than what Ellison has envisioned.
Yeah.
And so Bronfman will argue that Ellison's plan involves this dilution of buying Skydance Media for $4.75 billion. And Ellison will argue that, hey, we're actually buying back a lot of Paramount shares from investors, giving them money right away. So that's what the board's going to have to decide.
What about the investment, though, a longer-term investment? I thought that the proposal that was on the table coming out of Ellison seemed to have a higher commitment to reinvestment in the business than at least what we know publicly about the Bronfman bid.
Certainly more dollars invested. I mean, over $8 billion coming from the Ellison family and their partners, in addition to the business of Skydance Media. They're proposing really a change in management. David Ellison would be the CEO. Other, more seasoned executives coming in on the entertainment side. Bronfman hasn't made that commitment yet, so they do seem different in that regard.
With regard to whether shareholders get on board with this, I noticed that in our reporting, Chris, Mario Gabelli, of course, one of the largest holders on the Paramount side of this equation, the Skydance side of this equation, I should say, has basically said, look, Bronfman definitely has the credibility, something that maybe a couple of the other bidders that have been kicking the tires didn't necessarily have. I guess the question now is this going to boil down to a question about money, about the investment in the business going forward, or about the credibility of who put the proposal on the table?
I think ultimately it has to come down to money. If the board rejected a lower proposal, it would have either way, it seems this is going to result in some litigation from some unhappy people. But Gabelli is very focused on what he's going to get for his voting shares, and it's possible that he'll get a bit more out of the Bronfman offer. Maybe Ellison then offers a bit more. I mean, I think it will come down ultimately who's got the best financial picture here. At this point, Chris, has anyone else come back into the market, make another bid, or I don't know, another random billionaire somewhere? The clock is ticking. Got 24 hours. We haven't heard of any other last-minute bidders. And the Bronfman Group is really an amalgam of other people, like film producer Stephen Paul and that, who had kicked the tires for a while. So he's already, sucked up a lot of the other people interested. All right, Chris Palmeri here, helping us cover the latest development here in the Paramount Skydance saga. Now, Edgar Bronfman Jr. throwing his hat into the ring. And of course, if he does get this, Alex, I mean, he's going to have to invest a lot in content. And those content costs continue to get higher. I don't know if you listen to this podcast. It's called Call Her Daddy. Mm-hmm. And it's very popular. Mm-hmm. I know you don't listen to it. I know I don't. I just don't listen to podcasts in general. But get this, I'm going to make you weep. Okay. This young lady who's only been doing this a few years, probably like at least half our age, $100 million 3-year deal, according to a person familiar with the situation, to broadcast on Sirius XM. I mean, good for her, right? And then Bloomberg Intelligence was reacted to that actually and put out a note and said, look, that should really help invigorate subscribers for Sirius XM. The podcast apparently has the third most followers on Spotify at 3.7 million. Oh, it's huge. And I mean, it's like, and the thing is, you think about these sort of tentpole type of audio programs. You go back to the old days of, Howard Stern, moving to satellite radio, or Joe Rogan when he had that gigantic deal that everybody thought would never be eclipsed. And now you have something like this. And it just shows that if you can get a podcast that really can bring people to your platform, then maybe it is worth an obscene amount of money. We were also talking about that the Smart Less also podcast hosted by Will Arnett, Jason Bateman, and Sean Hayes. That 3-year deal is worth more than $100 million, but hers is worth more. Yeah.
That's right. It's popular, Alex.
Yes.
We got to get you listening to
I'm
it.
not auditory. It's not my thing.
Okay. All right. Well, when we come back, we're going to switch gears here and talk a little bit about weight loss drugs, as we always do. Eli Lilly shares on the rise again, but this is actually not necessarily about weight loss. We're going to talk about Zepbound and, well, what it could be used for beyond just losing weight. It's in our top calls, and it's coming up next. This is The Close on Bloomberg. All right, let's get a view from the sell side. It's our top calls, the big movers on the back of analyst recommendations. And we start off with Verrone Realty, getting a double upgrade today to outperform over at Evercore ISI. Verrone has been outperforming the REIT index, and Evercore says there are even more catalysts on the horizon. That includes a sale of at least 2 of its marquee properties in NYC. The price target going up to 38 from 32. The shares up by about 1.5%. Next in line, let's take a look at Palo Alto Networks with Morgan Stanley sticking with an overweight rating on the shares, but nudging the price target up to 390 from 360 following the cybersecurity company's mostly solid quarterly earnings report. The analyst cites billings beating consensus and says between multiple product cycles, AI tailwinds, and easier comps, top-line acceleration is on the way. Those shares higher by 8%. And finally, Celsius. Morgan Stanley worried the energy drink maker may be losing a little bit of fizz. While the analyst does maintain an equal weight rating on the shares along with that $50 price target, he says that year-over-year sales growth slowed again this month and adds that the market share remains flat. They see a path to Celsius, though, achieving mid-teens share of the energy drink category, but warn category growth may remain anemic for several quarters. Those shares moving lower by about 4% on the day, and those are some of our top calls. Let's switch gears now and take a look at Eli Lilly. Those shares up again, about 3% here on the day. This after a study revealed that the company's blockbuster weight loss drug Zepbound cuts the risk of diabetes in obese patients by 94%. News that definitely kicks the battle of the obesity drugs into high gear. David Reisinger joining us right now, Senior Managing Director over at Leerink Partners. Let's talk a little bit here about the, multiple use cases for these drugs. And I know this still may be a little bit far off in the future, David. But when we start talking about being able to use Zepbound and some of these other drugs for something other than just weight loss and diabetes, do you see a viable and, more importantly, a profitable track to doing that soon?
Yes. Well, first of all, thanks so much for having me. And absolutely, that's really the value proposition here, that these drugs aren't just for cosmetic benefits. And specifically, Zepbound offers transformational health benefits. We've seen it with the results in patients with various cardiovascular risk factors, with kidney disease. We see benefits now today in pre-diabetic patients, so reducing the risk of ending up with type 2 diabetes by 94% in this specific trial result this morning. Mm-hmm. And I would just add that beyond the top line release, what the company mentioned was that for patients that stopped therapy for 17 weeks of follow-up after stopping therapy, they regained weight, and their risk of progressing to type 2 diabetes then spiked. So patients need to stay on these drugs in order to benefit over the longer term from the significant health benefits.
One thing I am curious, though, when we start talking about these other use cases for these drugs, does this introduce a new set of potential users, potential customers, or is this basically just going to be the same group of customers that might have already been using it for weight loss purposes?
Yes, absolutely. So it is definitely additional customers because, as you're probably aware, many employers and insurance companies don't pay for drugs for the basic indication of obesity, but they will pay for additional health conditions. And it's sort of sad in a sense that the healthcare system in the U.S. is designed, and drug reimbursement is designed to treat patients that have disease rather than preventing disease. Mm-hmm. But specifically in the case of tirzepatide, Lilly should garner approval for the treatment of sleep apnea next year. Obviously, there's significant overlap between patients that have sleep apnea with patients with obesity, or said another way, the majority of patients with sleep apnea are overweight or obese, not all. But we do see opportunities for additional indications for tirzepatide, in the form of Zepbound to drive long-term sales growth.
Well, David, to that point, Bloomberg reported that it looks like Eli Lilly is looking at Zepbound to help treat psoriasis. What do we know about that potential?
Well, that's a new one for me. I guess I would say that, look, there are lots and lots of potential health benefits. I wasn't aware that they specifically were evaluating it in psoriasis. I will say that one of the benefits of Zepbound is that it causes a reduction in inflammation. That could be a little bit of the angle that you may be referring to. But the significant benefits that accrue to patients that are on Zepbound are reduction in blood pressure, reduction in bad cholesterol levels, obviously improvement in the ability to breathe and sleep at night. And these other health benefits that I mentioned, and that ultimately should accrue to insurers and employers in the form of worker productivity. That if people are able to move around easier, they're healthier, they're more active, they'll probably be more economically productive, and I think that's something that's important that should come into the equation in coming years as well.
Yeah, and I should clarify, it's going to be Zepbound with their psoriasis drug, but the idea, yes, it's an anti-inflammatory and sort of that effect. Just real quick, you have a $990 price target and an outperform rating. How much of that accounts for Zepbound?
Good question. So, yes, so that price target represents 40 times our 2025 EPS estimate, and that's a PEG ratio or P to growth ratio of 2.0 times our 5-year EPS growth rate of 20% from the 25 base through 2030. There is a significant portion of that that reflects the opportunity in obesity and various comorbidities associated with obesity, but we don't specifically break it out in a dollar amount.
Okay, David. Hey, look, we really appreciate it. Thank you very much for joining us. David Bahnsen of Leerink Partners. Thanks very much. I was talking to Sam Fazeli at Bloomberg Intelligence on radio, and he was saying, look, a control group is the perfect group, right? In reality, people on Zepbound or the GLP-1s take it for a lot less. They take it for maybe 40 days or something. Like, it's not the full time. So that's a different sort of set of circumstances. Yeah,
it'll be interesting to see whether this almost feels like AI. It's like there's a lot of sort of pie in the sky things that it's going to do for everyone. And maybe the reality is maybe a touch
maybe it's not
below
100%
that.
Magical. I don't know. All right, coming up, market downturns and companies. What do they do with their cash? This is Bloomberg.
Everyone is looking for a way to get into the bond market and frustrated beyond belief because they never got to buy at yields of 5 to 6%. And once rates start coming down and money market fund returns start to drift lower, that money will come in.
That was JP Morgan's asset management global head of fixed income discussing current interest rate bond investment right now. It is just about 3:30 right here in New York. This is the countdown to the close. I'm Alex Steele.
Romaine Bostic here, and we talk about, I guess, everybody's focus right now on the bond market, and particularly on the shorter end of that bond market. This has basically been a cash market, and I mean that in the literal sense here. Everybody is basically just gravitating to those higher yields at the shorter end of the curve.
And that raises his point of the money markets, right? You have money market funds, record $6.22 trillion. Where does that belong to as rates wind up coming down?
I was told that was cash on the sidelines and then was just ready to come into the game.
We haven't seen it yet. I don't know. Do rates need to fall in order to put that money to actual work because you're going to make less on your Marcus savings account?
Absolutely. I mean, the key word there is, are you going to make less? Right now, of course, you are making a good deal of money if you are in on the shorter end of the curve, whether you're an individual investor, whether you're an institutional investor, or whether you're a corporation. And of course, corporations always have to find a way to manage their cash. And our next guest helps them do just that. Vanessa McMichael joining us right now. She's the head of corporate and public entity strategy over at at Wells Fargo. And Vanessa, we've been talking a lot about cash management for corporations, particularly as we start to see interest rates potentially start to come down, but still at a time where we still see interest rates elevated enough where it gives some incentive to keep cash parked in money markets and other sort of short-term duration securities. Are you seeing any shift, though, in that strategy as we await the next step by the Fed?
Well, hello, and thank you for having me again, Romaine, and thank you for that question. So the last time I spoke to you all, and given my focus on corporate clients, this question is very topical, but the last time I spoke to you both on this show, this has been a constant kind of tug and pull with our corporate clients because the value is on the front end of the curve, right? So government money market funds, your bank deposits, that's where our corporate clients who are very conservative investors who seek preservation of capital and liquidity above everything else, we're preferring to keep their cash. However, since the last time I spoke to you all, it seems like our corporate investors have now accepted that we are very close to the first Fed funds cut. So when I spoke to you all before, a few months ago, I commented that our corporate clients weren't necessarily all in unison in terms of just expecting the rate environment to fall. They didn't necessarily believe the expectations because we've seen expectations change so much. We fast forward to today, we're seeing clients accept this, and we've spoken to a number of clients over the past few months, corporate clients, where we were having this conversation, and they finally have implemented like a bond ladder. And this is a conversation we've been having with them over the past year. And so we are starting to see some movement out of government money market funds incrementally into some term instruments.
So when you start to hear that type of conversation here, because at the end of the day, though, these companies still need obviously a significant amount of liquidity, but you're also competing now. There's been a lot of discussion, Vanessa, about the CapEx spend, at least among a certain cohort of tech companies, and how you balance out spending on these new projects or investment in these new projects, obviously whatever cash management you need in the bond market, and then, of course, anything else you want to do with that cash, such as reinvestments or buybacks here. What are they talking about with regards to the balance of all of those things?
Good question. And yes, that's a constant battle, right? Or balance, I should say. I shouldn't call it a battle. I should call it a balance. Because these corporate clients largely have two buckets of cash. It's their operating funds, and then they have strategic cash, which they are using for projects in other areas of the business. And so this is why our investors are buy and hold investors, and they're investors that are focused more on cash flow when they are making investment decisions rather than always trying to achieve the highest yield or highest return. And so that's a constant battle, Romaine. We are, like I noted with the first question that I responded to, we are starting to see some incremental movements into that strategic bucket, so lock in a little bit of term, and that's because we are faced with a near-term rate cut. And so that's the reality right now.
What do corporates do with corporate credit right now?
So we have some corporate clients who are actively invested in credit markets, whether that's on the very front end in something like commercial paper or a little further out, right, and call it high-grade corporate notes. For those clients where yield is the absolute priority, even though we continue to talk about how the rate environment is on the verge of changing, and I'm telling you this is largely accepted by corporate clients. For those clients who are really focused on maximizing yield regardless, we do try to talk to them about high quality credits. So if they are invested in the investment grade corporate bond market, it's going to be very high quality credits, big, well-known names, public companies, very large companies, because that preservation of capital is something these corporate investors, even though they are also issuing in capital markets, are just very sensitive about.
Yeah. I mean, this might be a dumb question, but how do corporates right now look at the equity market when we're in a changing rate environment and we're in sort of a different kind of corporate rate environment as well?
So that's a question that I would have to defer to my equity colleague over on the equity strategy team. But what I can tell you from a fixed income perspective is that this dialogue with our clients about taking some of that cash, reasonable cash out of our liquidity bucket, and deploying it a little further out on the curve is a more active conversation today than it was a few months ago.
Interesting.
When we talk a little bit more long term, Vanessa, and this idea of not so much cash management, but the idea here of companies have become a lot more financial, the larger corporations, in the sense that they're not just sort of making these investments for cash management purposes. Some are making them for actual investment purposes as well here. Is that investment case similar to the cash management case, or are those two completely separate things?
So I think it's similar because whether we're investing to cash flow match, right, or investing some strategic cash because we have a reasonable basis to expect that we don't need it and can invest it as a pure investment vehicle, we're still using the same investment policy, right? We still have the same comfort with risk in markets, and so the conversation is all kind of intertwined.
Is there any sort of appetite for I guess, not just corporate credit, not just treasury bonds, other areas, other pockets of the fixed income space that people are gravitating to?
Yes, and so very good question, because one of the conversations, active conversations that we're having with clients right now as well, who are very focused still on maximizing yield, right? There are a few ways to do it. It's extending maturity, and that's one way we can do it by just investing in simple government securities, not taking on credit risk. We can do it in the credit market, in the high grade bond market, but we could also look at structure, right? There are callable securities, right? That's one instrument that some of our corporate investors buy, where you receive an above market return today if you're comfortable taking on that reinvestment risk. So there are other ways to maximize yield, and we're certainly involved in those conversations as well.
Vanessa, we really appreciate it. I feel like investors are also trying to rethink that at the same time that corporates are as well. We really appreciate it. Vanessa McMichael, head of CPE strategy over at Wells Fargo. Quite interesting. You have to wonder, like, in a totally different change, like regime change of rates, like we're not going to 0, but we're not going to be at 5. Like, how do you rethink it? Like, what if we stay at 3.5?
Yeah, and when do you rethink it, right?
Exactly.
I mean,
you want to get ahead of it.
Yeah, or do you just wait until you get that clarity? But I don't know, you might be waiting forever.
Yeah. Exactly.
All right, coming up here, we're going to talk a little bit about Boeing. Those shares down almost 5% here on the day. The aerospace giant said to be halting test flights for its 777X vehicle due to more issues related to damaged parts. It's our stock of the hour. We discuss coming up next, right here on The Close on Bloomberg. It's time now for our stock of the hour. Taking a look at Boeing, the company experiencing some unexpected turbulence as the plane maker pauses flight tests of its 777X jetliner over cracks in a crucial part of the aircraft. Abigail Doolittle joining us for more to talk a little bit about exactly why we're seeing such a severe share reaction today. The share is down almost 5% on the back of this news.
I'm actually surprised by the degree of the reaction. And I think that if we didn't have this timeline of, two tragic plane crashes back in 2018, 2019, earlier this year, the door plug, then the bolt missing as the part of the story, the 90-day review from the FAA, and the story goes on and on about problems that Boeing has had, we might not be talking about this. It might only be a story limited to aviation and aerospace type journals and journalism. But because we do have this timeline of events for them, we're putting focus on it. So in terms of what's happening, it's the piece of the connection. It's apparently some sort of a strip that basically connects the engine to the wing. I should mention this was a test flight. It was under tremendous stress. They were speeding up, slowing down, really putting the plane under as much stress as they possibly could. So it may not be surprising to see these cracks. Again, that's why if it weren't a Boeing issue, we might not even be talking about it. But I think because Boeing has had this timeline. I mean, I started to write out a timeline. There's like 5 events per month this year that really sound pretty bad. That's why the focus is going on this at this point.
Well, not even that, though. You also have labor issues, right? That like potentially you could see a really crippling labor strike. And they're also to integrate Spirit Aerosystems as well. And that's irrespective of the 777X.
Well, I'm so glad that you're bringing this up, because the bigger issue here is the company overall, and what is Kelly Ortberg going to do with it, the new CEO. George Calhoun is out.
He's been there for like a week, right?
Yeah, it's been a very short period of time. So, you certainly can't blame this on him in any way. But he has to really figure out what's going on at this company. And in some ways, a piece of it is the manufacturing of the planes. They used to have this big engineering culture, and they, over the last 5 to 10 years, have switched more to a management culture. Then plus with the pandemic, manufacturing of pieces and components, chips, abroad coming back to the U.S., but it's just not as tight. So he really needs to fix that. But there's also not just the labor issue, to your point, is people who actually would know how to weld the pieces. You know, if you talk to any consultants who go into these plants, they basically say that the process, it's completely undocumented. So the person who used to know how to do it perfectly with some, you know, of their own little way of doing it, it's not documented. Somebody new has to figure that out. Plus, is there the interest? And, you know, it needs to be a trained workforce. So, yeah, they really have their work cut out for them.
Yeah, no, it sounds like a lot. You also have to wonder, too, though, in terms of their inventory. Like, does the delay in the 777X affect their inventory management at all, I wonder?
Well, you know, so the big goal is in terms of the 737. So their goal is to produce 38 per month. I think the last month they produced 31. So they're not really quite on there. In terms of the XXX, and if it does affect inventory, they actually have started making some. So they're clearly going to have to redo those a little bit. I don't know if it will affect their inventory right now. I think really more the focus is whether or not they can produce those 737s as much as people want.
All right, Abigail, appreciate that. Thank you so much. Bloomberg's Abigail Doolittle joining us there. I think the thing with Boeing is, like, it's going to survive, right? Because it has to, because there's like two of them. Right. I mean, there's some Chinese competitors, but still, in terms of Western manufacturers. But like, at what point have we finally hit the bottom?
I don't know. I mean, I feel like it can't get any worse until it does. But here's the thing, too. I mean, it's kind of interesting because you talk about why we would see such a severe share reaction for something that probably to a certain extent is routine. I mean, you tend to see these types of malfunctions during these test flights, but that's the whole point of testing them. But it's more the compounding of all of this, right? It's just the perception that there's always something going wrong, whether that's fair to Boeing or not, is almost irrelevant, particularly on a day like today.
Yeah, down 4%. All right, coming up, we're going to count you down to the closing bells. Chris Verrone, partner and head of technical and macro research at Strategas, will be joining us as you're looking at an S&P off by 0.2%. This is The Close on Bloomberg.
I do think some of the defensive sectors of the market are very likely to go the other way, zig when the market zags. And so you really are kind of seeing right now a very, shall we say, up and down market that is range bound, but it doesn't feel that way. People think they're doing real well. The NASDAQ's up about 3% per year for the last 3 years.
David Bahnsen, the Chief Investment Officer over at the Bahnsen Group, kicked us off to the close just about 50 minutes ago. Romaine Bostick here alongside Alex Steele. We're calling this a halt in the rally, but we should point out most of the losses today are relatively modest.
Yeah, and also the bulk of the losses for the S&P are actually in the energy index, which you could argue would be a little idiosyncratic versus sort of a broader risk-off move. But then you have Palo Alto totally crushing it, doing really well. Best performing stock in the S&P, so go figure. Yeah, and you wonder if that raises a question about it being more of an idiosyncratic market. We do have the Russell actually down significantly on the day, though. They are down about 1% here as you're starting to see some sell-off there, although we should point out the Russell also, I guess, suffering some of the same fate as the S&P, with the energy stocks kind of dragging a lot lot of that index down. Yep, exactly. So it is like, is it a break or is it a buy?
I guess we're going to find out.
Yeah, we are.
By tomorrow morning or maybe a little bit after that. Chris Verrone can maybe provide some answers. He's partner head of technical and macro research over at Strategas Research Partners. Chris, all right, I know you can't really answer the question as to where we go next, but I'm going to ask you that anyway. Because, I mean, look, when you look at the rally that we had, this mini rally over the last 8 days, and call this whatever it is today, a halt or pause or whatever, do you think there's enough here in the tank when you look at the technicals and you look at fundamentals for this rally to reset, or should we kind of prepare ourselves, as David Bahnsen was suggesting, for a more range-bound market?
Well, I think ultimately, if you're looking out next 3, 4, 5 months, I do think there's probably more in the tank in this longer-term advance. I'm a little bit less convinced maybe next 4, 5, 6 weeks. We've done a lot here since that August 5th very impulsive panic low. I didn't think we were deeply oversold on August 5th, but certainly enough to kind of get some type of response. We're back at the highs. As I said to you off air, I actually want to see this market get very overbought. Only good trends get overbought. So if we're going to kind of maintain the integrity of this uptrend, you would want to see all the momentum indicators get very, very extended. That's a sign of a good trend.
Well, I'm curious that when you look at those momentum indicators, and let's take August out of the way, because a lot is being distorted right now because a lot of people aren't at work and a lot of other factors at play. But if those momentum trends continue to get up to those overbought levels but don't actually cross them, does that create concern for you?
Well, I think what you really have to monitor is kind of how the character of this advance evolves. And, you know, if there are some things that are maybe different the last 2 or 3 weeks as we've rallied, you've seen it on the macro, right? Much of the move this year was with DXY up. This one's been with DXY down. We've seen gold break out. Bond yields have not caught a bid here. Bond yields are still hovering at that 380 range. I want to see things like consumer discretionary reassert themselves. I'd say it's early to suggest that's happened. I would want to see beta and momentum factors really reassert themselves. That hasn't been really the story the last 2 or 3 weeks. So we need to be on guard that maybe the character of this market is evolving. I think it's kind of more resembling a mid to later cycle tape, not an end of cycle tape, but certainly it looks different from a character perspective than we've seen.
What about the dollar?
Yeah.
So the Bloomberg Dollar Index is like over 1% below 200-day moving average. The chart looks really terrible. Why do you think this is happening, and what's the downside?
So why do I think this is happening? I think this is happening because the Fed's late, and I think the Fed should be cutting.
So that is a fundamental thing. It's not technical. Citi was saying that the carry trade is alive and well, borrowing in dollars.
You know, I think that's a good line. I think I think the charts reflect the fundamental consensus, and I mean DXY has been weakening and weakening and weakening and weakening. It broke over the last 48 hours. What's been strong all year has been gold. I mean, gold has known it the whole time. So even when dollar was going up, gold was going up more. So we never really bought into the idea that that dollar was particularly strong. But I think what you really should be focused on is rates. I mean, we've had this very big rally in the S&P back to the highs. Why have 10-year yields not gone up? Right? If we've totally erased the recession concerns that were so prominent after the payroll print of August 2nd, why have bond yields not gone back up? That's one troubling aspect of this bounce.
Can we make an argument, though, that they're saying the same thing? That the Fed's going to cut, yay, equity market, and the Fed's going to cut, yay, go buy bonds. Like, are they actually saying the same thing but for different reasons?
Well, what I've wondered is if this is an environment where we're transitioning into non-recessionary rate cuts. You go back to 95, last time we had that. The leadership mix was interesting. Like, I think intuitively you would expect tech to do very well in that environment. It didn't. It was financials that really drove the leadership kind of around those non-recessionary cuts in 95. So I think it's essential for the financials to remain involved in this market. I don't think we need tech to the same degree we've had tech all year, but we got to keep financials involved. That was really the lesson of okay, soft landing, non-recessionary rate cuts, bullish for banks, bullish for financials broadly.
And financials have been doing okay over the last couple of months. I am curious, though, about the breadth of the market overall. I mean, we're now looking at an S&P where something like, 70% of the names are at or above that 200-day moving average, generally a bullish sign here. And even the Russell now seems to be trying to play some catch up, although it's had some trouble here. Do you see a convergence at all in the fortunes of what we're seeing in the large cap tech space and what we could potentially see in small caps?
Yeah, I do for a couple of reasons. I'd say number one, as you know, we entered the day with 76% of issues above the 200-day moving average. All year that has not gotten below 60. I think it's a really important line in the sand, right? If we're going to sustain the integrity of this market, you really want to keep 6 out of 10 names above their 200-day. So we have a little breathing room there. I think how that evolves over coming weeks and coming months will be key. I think the other thing on the tech point, which is really, really critical, we've seen tech rally in absolute terms. But all these tech indices, whether it's equal weight or cap weight or small cap tech or mid cap tech, none of them have reclaimed their relative performance high water marks from earlier this summer yet. So if the character of the leadership fabric of this market is evolving, maybe tech actually starts to roll here from a relative performance perspective. Obviously, the NVIDIA numbers coming up next week are certainly what people have their attention on. But the SOX, for example, the semi-index, has not even taken back its 50-day moving average here. So it's more split in tech than I think people give it credit for.
Is NVIDIA going to be a market event, or is it just going to be an NVIDIA and AI, tech stock event? I
think to the extent that one stock is 5, 6, 7% of the S&P. Of course, it's going to be a market event from that perspective. We talk about it every day, and frankly, I'm wondering if the negative outcome is actually a beat where the stock doesn't make a new high, rather than a miss or a downgrade.
Yeah. Have you bought one of these GPU chips from NVIDIA?
I have not.
Yeah.
No.
I feel like it's like I feel like it's a bar of gold right now. Like that might be a better hedge against inflation than gold or Bitcoin. Chris, great to have you.
Always a pleasure.
Chris Verrone, partner, head of technical and macro research over at Strategas Research Partners, counting you down to the closing bells. And Alex, usually the last few sessions we had seen a little bit of buying into the close. It doesn't look like we're seeing that today. In fact, seeing a little bit of selling, a touch of selling here into the closing bells.
Volume still light as it was all week last week as well. So again, I thought your your question of is NVIDIA going to be a market event or just an NVIDIA event is going to be a good one, particularly if we wind up having volume still really light in that last week of August. Have positions shaken out enough that we get a clean read?
Yeah, absolutely here. So on this day here, even though you are seeing red across your screen, still a healthy number of companies in the green here on the day. We've been talking about the dollar weakness all day. The VIX moving slightly higher back to that 16 level, and your 2-year yield back below 4%. A full breakdown of all the market moves on the day coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you to the closing bell. A global simulcast starts right now. Scarlett Fu joining us in the television studio. Tim Stenovic in the radio booth. Katie Greifeld filling in today for Carol Masser. We welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube here. Tim Stenovic, no buying into the close here. It looks like we are going to end the day across the board in the red.
Yeah, first down day for the S&P 500 in 9 days. It's too bad for those keeping track at home who would have seen quite the record. If we did see 9 days in a row of gains for the S&P 500, it would have been its longest winning streak in more than a decade. But does not look like we're going to make it there. Turns out, Katie, stocks also go down.
Yeah, nice reminder there, of course. Also, volume goes down, too. You take a look at trading volume on the day, just falling off a cliff, down 25% on the S&P 500 from its 20-day average because, I mean, the real action starts tomorrow when it comes to catalysts for this market. We have revisions tomorrow and then, of course, just the drumbeat to Jackson Hole.
Did you say revisions on the job numbers?
Yeah. Payroll revisions.
Could be big. Hundreds of thousands, it could be.
Gird yourself.
We say it could be big, and then we should prepare ourselves for absolutely nothing happening and everyone talking about Jackson Hole.
The next catalyst, perhaps.
But, there is something happening in the FX market, guys. I'm kind of obsessed with what's happening with the dollar. The Bloomberg Dollar Index now down by about 0.2%. It's been rolling over significantly and really below some strong moving averages. And I got to wonder, what does that mean?
Yeah.
Anyone?
What's it mean?
I don't know.
Romaine, please answer the question.
I don't know. I'm still stuck on Katie's girding for revisions. What time does that come out, Katie?
I think it comes out pretty early in the morning.
Don't let him fool you. He's totally into this, by the way.
I'll still be asleep.
He's into it. No,
we get the closing bells in New York, and as required, everyone still has to clap and cheer despite red across the screen. Modest losses, to be sure, on the day with the Dow down roughly about 62 points or about 0.1%. The S&P 500 down 11 points or 0.2%. The NASDAQ composite down about 0.3%. And the Russell 2000, that's your big underperformer here on the day, moving lower by 1.2%.
Okay, finishing down by 0.2%, the S&P 500, that is. We did see, though, 170 names in the S&P 500 move higher today, while 330 names did move lower.
And when you look at the sector performances, it's pretty much ho-hum. Out of the 11 sectors, only one moved more than 0.5%, and that would be energy. Energy stocks declining about 2 2/3% on the day, whereas you have materials, financials losing ground by about 0.4%. The gainers include some of your perennial defensive groups like consumer staples, healthcare, and REITs.
All right, I got a gainer for you when it comes to the cybersecurity space. Let's start with Palo Alto Networks. Shares jumping today by 7% on the day today. This after the company gave a strong forecast and boosted its share buyback program. They managed to grow sales 12% last quarter. That was faster than expected. Full year sales of just over $8 billion. That was in line with consensus expectations. Remember, this was all moderated after it cut its outlook earlier this year. You'll remember back in February, the stock took a big hit after the CEO said that customers were suffering from, quote, spending fatigue in cybersecurity. The value of shares plummeted by a record 27%. Just about 6 months ago. So a nice recovery for Palo Alto Networks, at least today, in the wake of its most recent earnings report. Also, ticker HA, Hawaiian Holdings Incorporated, higher today, jumping to the highest at least intraday, going back to June of 2022, finishing higher by 11.3%. This after the time period for the Department of Justice to complete its regulatory investigation into the merger with Alaska Air actually expired. The deal does remain subject to other conditions, including approval from the Department of Transportation, Alaska said in a statement. And finally, SiriusXM Holdings, SIRI, is the ticker, higher today by close to 7%. This after the company announced it signed a multi-year deal for Alex Cooper's Call Her Daddy podcast and network of shows. It's going from Spotify to SiriusXM. The idea is that it'll give SiriusXM exclusive rights to sell ads on the audio and video versions of her show, bonus content and events. Cooper had 4 million followers on Spotify, the 7th most popular podcast in the U.S. Remember, next year, Howard Stern's contract with SiriusXM expires, so an important content move coming from the satellite radio company.
All right, let's look at some of the decliners. And I'm going to start with Boeing. Of course, the story there, I think we all know it, that Boeing halting 777X.
I thought revisions were the story.
It is the story, Romaine, but not until tomorrow. So let's talk about Boeing right now. Halting those test flights of its 777X jetliner while it inspects some crucial structural component parts. Apparently, the component that connects the engines to the plane's wings having some trouble, as I understand.
Should that stay together? Or
it's very important that it does. So they're going to pause those flights right now, and you can see shares down 4% intraday, just adding to Boeing's bad year there. And then my next two stories, a bit of a twofer here, because of course we all saw the news about Eli Lilly's drug Zepbound cutting the risk of diabetes by 94% in a 3-year study. You take a look actually at some of the diabetes device makers, Dexcom and Insulet, some of your biggest losers in the S&P 500 today. And obviously we see sort of a pair trade emerging there because Eli Lilly had a great day.
Yeah, no, fair enough. That's a really good point. By the way, guys, just so we get rid of any question marks, 10 a.m. apparently, according to EcoGo, is when the BLS will release preliminary annual payrolls benchmark revisions.
Why so early?
It's going to be so exciting for
everybody. A great
everybody.
Trio of anchors, though, on open interest will be there.
Katie will be there with Shanali as well as Matt Miller. All right, I'm going to the bond market here, guys, because there was a pretty solid bid all across the curve. Yields lower, 2-year down by 7 basis points. You with the 10-year also down by about 5 basis points. I mean, yes, you also have the weaker dollar. I'm just trying to make sense of kind of what is happening within the FX market. I'm a little bit more into that than bond market. But anyway, some buying into tomorrow.
All right, well, one market that we're certainly interested in is the New York City real estate market. And among the most read stories on the Bloomberg terminal is a story about how the city is planning to sell apartments on the Upper West Side of Manhattan, just 2 blocks from Central Park. The real news here, though, is it's not going to cost millions of dollars for one of these apartments as it typically would at market rate, as low as $173,801, Katie.
Yeah, it's pretty amazing, of course. These apartments are going to be sold via lottery to New Yorkers that make less than 120% of the area's median income, who have no more than $280,000 of assets, and more than 10,000 people have already applied ahead of the August 27th deadline.
10,000?
So that supply-demand imbalance
how many
applies
apartments are in
here.
this
That's the thing. There's 17 studio and 1-bedroom units available.
It's literally winning the lottery.
Yes,
Amazing.
more than 10,000 people applying for that. I mean, that's harder than getting into like Harvard University.
Is this the building? Oh, I know that.
Well, but the best part is, no, it's not the building. So that's near there.
Oh, we're just showing random buildings?
No, but the reason why is because like a 4-bedroom just sold in that building for like $7.8 million.
Wow.
And like a studio sells for like $1 million. So just to put in an idea, like
context.
this is the building where the apartments are, but it's right by the Natural History Museum. They redid all the apartments inside.
Yeah.
This is amazing. This is how you build wealth, you guys. I love this story.
Okay,
if you win the lottery.
Yeah, good for them.
Someone's got to do it.
Yeah, for those 17 people. Good.
Well, that's an interesting question. Could you actually, if you win this lottery and you get the unit, can you then sell it for, several million dollars?
Right? I mean, maybe there's
actually restrictions on it.
But if you sell, then you have to find another piece of property. So that's another problem.
But eventually
right?
they can sell it at some point. That's going to accumulate wealth, right?
Yeah.
All right.
But can they sell it at market rate, or
do
does it always have to be sold at a percentage of the folks who?
There's a lot of fine print, I'm
story.
sure, in all of this. The other story that we're paying attention to as we, of course, focus on the consumer and how comfortable or how confident they're feeling is this idea that everyone goes to Disneyland, or a lot of families like to bring their kids to Disneyland, but a lot of families are now starting to go into debt to pay for these Disneyland vacations because the trip costs anywhere from like $6,000 to $10,000. People are paying for it on their credit card and then taking a couple months to pay off their credit card debt.
Okay, these are pretty mind-boggling numbers. The story coming from the New York Times, as you mentioned, analysis from NerdWallet found that a 1-week trip to Disney can range from $6,400 to $15,500. It does not include flights or souvenirs.
Souvenirs. Wow, the
That's pretty
souvenirs,
wild.
that'll set you back another 10 grand.
No, for real. I mean, but that's the thing. Like, and people are willing to go into debt for this kind of thing as well. There was a great story in the article about a couple that went all the time every year. When their son was born, they kept going even when they couldn't afford it and put it on their credit card. That's insanity.
It's part of their family tradition, but also the costs have increased by a lot. If you want to go on the fast line and everything, you now have to pay, I think, $15 per person, whereas before that was free.
Yeah.
And things just add up really quickly. The shuttles that used to be maybe $25 flat are now based on surge pricing as well. So it's like taking an Uber to get from one part of the park to another.
What's the strategy then for new parents? Pretend it doesn't exist?
Yeah, don't tell. It's like just don't tell your
good luck
kids.
with that.
Don't tell your kids it exists.
Good luck with that. Too.
All right.
And don't get sick if you go to Disney, by the way.
So much fun stuff to look forward to. Thanks, guys.
Sure.
That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're all going to be back here tomorrow, same time, same place.
And stick with us. Our coverage here on Bloomberg Television continues a focus on the retail space with Oliver Chen, Managing Director in Retail, Luxury, and New Platform Sector Head over at TD Cowen. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Let's take a look at how markets finish out the day here. A bit of a pause to that rally. 8 straight days of gains coming to an end today, though the losses were modest to be sure. 0.2% lower here on the S&P 500, which was indicative of the moves that we also saw on the Dow and the NASDAQ. The Russell 2000, though, closing down more than 1% here on the day. Take a look at yields. You did see them drift down a little bit today. That 2-year back below 4%. Meanwhile, gold continues that march higher to yet another record high, and Bitcoin was under pressure all day long. Coinbase kind of representative of those struggles, down about 3.5% here on the day. Scarlett, I know you're taking a look at some of the individual movers out there here on the day.
Yeah, let's start with the biggest decliner in the Dow Industrials. That would be Boeing, losing more than 4% on the day after pausing flight tests of its 777X jetliner, which is experiencing some cracking in a part that connects the engines to the plane's wings. So clearly a setback to Boeing's efforts to certify this plane, but also adding to doubts overall about Boeing's manufacturing and safety record of late. We're also paying attention to SiriusXM, up almost 7% on the day after signing a reported $100 million 3-year deal with Alex Cooper, the host of the Call Her Daddy podcast. SiriusXM gets exclusive rights to sell ads on the audio and video versions of this podcast and all her other podcasts, along with bonus content. And of course, the timing is critical because SiriusXM's exclusive contract with Howard Stern expires in 2025. And Palo Alto Networks, we told you about this yesterday because it reported earnings had a beat and raise quarter. But to be sure, it did have to lower its full-year outlook just earlier this year. But nonetheless, the bar was lower, and it did beat it. And the cybersecurity company also approved another $500 million in share buybacks. So that stock up by more than 7%. But our top story this hour is housing. There's plenty of demand for it, but nowhere near enough supply, especially the affordable kind. Elevated mortgage rates and the lack of inventory of existing homes has held back transactions, which gives the home builders some flexibility to offer promotions of their own to secure orders. Luxury builder Toll Brothers will report earnings later this hour, giving us a glimpse into whether a softening in consumer confidence across all income levels will start to weigh on future sales.
All right, we're also keeping an eye on some other earnings scheduled tomorrow morning. Several retailers scheduled to report includes TJX, it includes Macy's, it includes Target, as well as a couple others that I'm sure I'm forgetting. It's a lot to talk about here as everyone is sort of focused on the health of the consumer, including here in the aftermarket, looking for earnings out of the beauty company, Coty. Oliver Chen covers the sector over at TD Cowen and pleased to say that he joins us here in Studio 2 in New York. Great to see you, Oliver.
Pleasure to be here. Thanks, Romaine.
Let's start off with the big stories here, and we'll start off with Target, because we got Walmart, so we kind of have maybe a sense of what to expect at Target, or have their fortunes kind of diverged?
Well, they have diverged to a certain extent. Walmart really focused on value and grocery. It's outperforming. It's our top idea of the year. We're more cautious on Target because half of this product is consumer discretionary, and the consumer has been at crossroads and somewhat cautious As you mentioned, delinquency rates and debt is quite high, and inflation is on consumers' minds. Walmart stands for value. It's also a leading grocer. 60% of the business is food, and that's been a real positive. Target's a work in progress with offering better prices and private brands renovating that.
Well, that's what I'm curious. Like, how did they get there to be more thought of as being more of a value play? Because, I mean, we go to Target a lot in our family, and I don't know. I mean, the prices look okay. I mean, I don't feel like they're like some sort of premium product.
Yeah, that's something we're watching with the margins and the gross margins, really investing in price to offer lower prices, and also constantly upgrading the private labels, the brands, to make sure they're modernized with new consumers. Apparel's been a very competitive market between Amazon, Shein, department stores. So these are all things we're waiting and seeing on Target. That being said, Target's PE multiple at 13 to 14 times is a lot less expensive than Walmart's 26 times.
You call Target a work in progress. You also call department stores, that business model, a work in progress as well. And Macy's, perhaps one of the most famous department store chains of all, is reporting earnings tomorrow. Is there an example of a department store that is actually working? I'm curious to hear what a successful department store looks like now.
Yeah, me too. The future of department stores is really theater and experiential. So there are cases of success, in my opinion, like Selfridges in London, which wasn't a public company. So in the U.S., unfortunately, a little too much consolidation and too many stores. So right now, we're in a reinvention phase. A lot of the best stores don't exist. That being said, Saks Fifth Avenue, the flagship, they've invested a lot, but really service has to come back to play and integrating digital and physical. The consumers change forever. So I'm still looking for excitement in department stores, to be honest, and we're cautiously optimistic. What should happen at Macy's is small format. So more convenient, small format, and better product. You can get this product anywhere and everywhere. So it's so competitive.
Have you had a chance to see any of their small format stores they've been experimenting with?
Yeah, less can be more. So you don't want to walk in a store like stack it high, watch it fly. That doesn't exist anymore. These small format stores offer more curation, better service. You can find the cash registers. Some great brands like Nike and Ralph.
Yeah.
So it sounds like cost cuts doesn't get them there, which is what a lot of them have relied upon. Bloomingdale's, of course, does have its own store brand. You were talking about private label, Aqua. How much runway is there on private labels in these big department store chains?
It's really the key priority because the nature of this online disruption is availability of products. So private label importantly, private label that appeals to younger customers as well as older. And competing on this basis. Bloomingdale's did a great job. Tony Spring coming from Bloomingdale's to head Macy's. It's a catalyst for the future. The younger customer is not excited by department stores. They will go there a little bit for beauty, but they love Ulta and Sephora, and they don't love the product. So we're in this difficult phase. Retailers like Revolve executing with influencers. The beauty industry, fragrance, and Coty we like. And then the bottom line on the consumer's looking for value. So low prices at Costco, low prices at Walmart. And, Target bringing back that style and value.
Well, you mentioned Coty. I mean, they're scheduled to report earnings a little bit later here. When you look at sort of these pure play beauty companies, what's the value proposition there? Because, I mean, Sephora and Ulta seem to be kind of the titans, at least in the physical space here. And I know Coty kind of has a different type of presence here. Where do they fit in?
We're excited about Coty because 55% of it is fragrance. So the fragrance market is quite vibrant. It's a little luxury. And on TikTok, perfume talk is widely used. So thinking about fragrances, an access point, accessible luxury, wearable jewelry. Americans don't use fragrance as much as Europeans. Big opportunity. And Coty's vertically integrated. So they make fragrances for other powerful brands like Gucci and Marc Jacobs and Burberry.
Yeah, all the kids now, are using these high-end fragrances.
Really?
Yeah, in my household, there's been requests for very expensive colognes that I don't think a 15-year-old actually needs.
Hashtag perfume TikTok, right?
Yeah, exactly. I mean, smelling good, looking good, feeling good. As you think about beauty, it's intersecting with wellness, and this is a hobby too.
Yeah, well, I was buying drugstore, Dracar Noir or whatever, Paco Rabanne or something.
That's
I
so
think it all
nice.
works. I mean, you need to start, and then it gets more advanced. And then,
don't worry, I've upgraded.
I mean,
I
love that.
It's
classics for a reason.
I'm getting up there.
Yeah.
Oliver, thank you so much. Always a pleasure seeing you
pleasure.
here. Oliver
Good
Chen
seeing you.
of TD Cowen.
All right, we had some breaking news crossing the wire. This is on microchip technology. The company actually announcing a cybersecurity incident here. It doesn't give a whole lot of details, but it does say that it expects it to, quote, reasonably likely have a material impact on the company here. The share is down about 3.5%. They were down as much as 5%. The company said it has shut down some of its systems already, but that it has been able to fulfill orders on some of the folks that have been impacted by this. We should point out that Microchip says it has not yet determined the full impact of the incident, other than to say, Scarlett, that it does expect it to likely be to have a material impact.
All right. It'll be interesting to see how this shakes out and whether there's any ripple effect down the road, the same way that the CrowdStrike incident did.
Yeah.
Of course, that was not necessarily cybersecurity. That was another incident entirely. Coming up, we've got the top 3 movers and shakers at the center of the day's big stories. This is Bloomberg. It's time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is David Goel. He's a Tiger Cub who trained under the hedge fund titan Julian Robertson, and he's leaving the industry. He is closing his $11 billion firm, citing health issues.
Yeah, I mean, look, we've seen a lot. Obviously, we track these Tiger Cubs relentlessly here. And I guess, I don't know, we don't actually know a whole lot about his personal health issues, but we've seen a lot of Tiger Cubs kind of bow out, right? There's been a lot of pressure out there for returns. We have no idea whether this is related to that.
Correct.
Or it truly is about, just make that clear here. But we have seen a lot of these disciples of Julian Robertson basically reach a point. But we should point out, a lot of these guys are maturing, and most of them, our guys, are maturing too. So, they're reaching an age where they've made good money, they've reached a certain age. Maybe they
move on to their next chapter, right?
Yeah, absolutely. Well, also moving on to the next chapter is Beyonce. I love this story for 2 reasons. We had a great story on the Bloomberg terminal how Beyonce has announced a new whiskey brand with LVMH. First of all, 2 great things about the story. First of all, they put her full name in the title, Beyonce Knowles Carter, as if somehow Beyonce, everyone would scratch their head and say, who is this Beyonce?
We use up too much room for that headline.
But that's a whole nother conversation. That's inside baseball. This is going to be an $89 bottle of whiskey, retail price. It's a blend of rye, malted barley, and its creation was led by a master distiller known for his work in Scotland.
And it's called Sir Davis, which is inspired by her great-grandfather, who made moonshine during Prohibition in the American South.
And I love the backstory to this as well. We've interviewed Fawn Weaver, who helped revive the Uncle Nearest brand under the sort of the Jack Daniels umbrella, and this idea of sort of the rich cultural tradition that African Americans had in producing whiskey in this nation, and the lack of recognition they had for so many years. So to see someone with her money and her clout and fame put it to what I think is good use is great to see.
All right, so Beyonce, watch out for that. Also on our docket, social media influencer Deja Fox. She's taking the stage at the DNC. No, she doesn't, but she has a blog. She has all kinds of other things. She's the first content creator to speak at the convention. According to her LinkedIn profile, she's an activist who's leading thought at the intersection of social justice and social media.
So I love this story for a couple of reasons. First of all, I don't know how much you're online, but if you are online and you see anything related to Kamala Harris, Walt's campaign, it seems like it's all just like these random influencers and young people creating these memes and TikTok. And I guess that's how you get interest in people. But
from the millennial crowd and the Gen Z crowd.
Yeah, I don't know if that appeals to people of a certain age. But for the younger generation that might be around 18, 19, ready to vote, maybe this is what pushes them over the edge, if you will.
Yeah,
Deja Fox.
Overall, 200 social media influencers have access to the delegates and the studios at the DNC. So she's not alone.
Well, Joe Mathieu, the co-host of Balance of Power, is actually on the ground in DNC, and I hope he's doing my city well out there in Chicago. 2 questions, Joe. First, have you had a chance to catch up with Deja Fox? And if not, who are you catching up with today?
I had to ask my 17-year-old who all of these people were. Guys, it's Brat Summer. They don't care about me. We can ask questions all day long, but if you can have 200 influencers deliver your message and connect with young people the way you're talking about, it's pretty valuable, and it's unheard of. We've never seen anything quite like this, using the actual, as you said, studio space at the DNC. We've been rubbing elbows with a lot of lawmakers. It's funny, a lot of the people we talk to on the regular in Washington who have all converged on this convention right now, all of whom are pretty excited about the next couple of nights. Barack Obama and Michelle Obama speak tonight. And as you're seeing on Bloomberg right now, a little surprise appearance from Kamala Harris last night, who was on stage to salute Joe Biden on his way out. So
what time
each
did that
night
happen? That was
you
like
get a little bit closer to the big speech on Thursday. That was about that. I was waking up. Look, guys, he didn't get on TV till 11:30 on the East Coast. How many people do you think saw that live?
Yeah, exactly. Aren't they changing things a little bit in terms of, making sure that the schedule is much more closely adhered to because of what happened? No one wants to see Michelle Obama at midnight. They want to see her during primetime hours.
Exactly. James Taylor got canceled, guys. That's not the way it's supposed to work. They canceled a few lawmakers. Yes, that happened last night. They canceled James Taylor.
Oh, man. The pride of Massachusetts.
No, I didn't. And I bet you they're going to find room for him. I'll tell you what, though. The big talker around here is just who you were just talking about a minute ago. Is Beyonce going to show up on Thursday night? We have been asking everybody, including the team's owners, if they know anything about special access or whatnot. Everything has been very hush-hush on this, but there has been a thought that, Beyonce playing Kamala Harris onto the stage would leave a mark.
Wow. Okay. So Michelle Obama, I think, was not even confirmed as a speaker until fairly recently. What other surprises are you looking for, Joe?
Well, it's hard to predict a surprise, I suppose, but tomorrow night is going to be important. Tim Walz is going to be up there with former President Bill Clinton, and we'll be in the hall for that tomorrow night. A really important speech. This is a running mate. Of course, we didn't know about it even a couple of weeks ago and has really just connected remarkably well with the delegates here. A lot of folks have been asking us about the protesters, too. It's really been a fairly subdued story so far, at least peaceful. A couple of folks jumped a barrier, but so far that's been about all that we've seen.
Yeah. All right, Joe, going to have to leave it there. Joe Mathieu on the ground at the Democratic National Convention in Chicago. Be sure to tune in to him and Kayleigh Lyons at the top of the hour as they continue that full coverage of the convention. When we return here, we're going to keep a focus here on the economy and politics and a look back in history at the federal minimum wage and the appetite or lack of it to raise it further. Here's a question for you, Scarlett. How long has the current minimum wage of $7.25 been in effect?
Too long.
All right, let's take a look back in history. On this day, back in 1996, U.S. President Bill Clinton signed legislation that over 2 years would raise the federal minimum wage from $4.25 an hour to $5.15. It was the culmination of a contentious years-long debate about federal wage mandates and what effect, good or bad, they had on the economy. The basic economic theory of supply and demand is simple. It's that as the price of something goes up, demand goes down. And that was the fear with the minimum wage, which was formally introduced all the way back in 1938 at a rate of 25 cents an hour, by the way. If you adjust that for inflation, that's about $5 today. Now, increasing that, critics say, would help workers, but ultimately cause employers to reduce costs elsewhere, including hiring less. A 1993 survey found that 77% of the American Economic Association said wage floor increases cause job losses, with the most pessimistic projections coming from the Economic Policy Institute, which estimated that the first of the two steps of that 96-97 minimum wage increase reduced the labor market for teenagers by about 215,000 jobs, or about 3.5% of the jobs available. However, other studies, including one by the Federal Minimum Wage Study Commission, found job reductions were closer to 1% to 2%, and a now famous 1994 paper by Alan Kruger that compared fast food restaurants showed few or no job losses at all. So there really is no agreement on this. Alas, the 1996 wage bill would be the second to last amendment of the federal wage floor that we've had. The last increase coming in 3 steps, starting in 2007 with a bump up to $5.85 an hour, which ended in 2009 with a bump to $7.25, which is where that minimum wage remains 15 years later. But now the minimum wage is once again a campaign issue. Kamala Harris pledging a boost and a baton pickup, if you will, from President Biden's pledge, a pledge he made back in 2021 to get the minimum wage to $15 an hour by 2025. It's a pledge that, with exactly 5 months until the completion of his 4-year term as president, is still a dream deferred. Scarlett?
All right. We have some breaking news I just want to get to. Coty, which is the cosmetics company, reporting a loss for the quarter that was narrower than what analysts had anticipated. A 3-cent loss per share. Analysts were looking for somewhere in the neighborhood of a 4.7 loss per share. In terms of revenue, $1.36 billion, slightly lower than what was anticipated. And in terms of the gross margin, 64.2%, that was wider than the expected 63.5%. As for the 2025 outlook, it sees adjusted EPS of 54 to 57 cents, and the average analyst estimate is 57 cents. You're seeing the stock decline modestly in after-hours trade.
Yeah, interesting to see those shares move lower. Meanwhile, moving higher is Toll Brothers. Those earnings just coming out for the luxury home builder here. And the numbers on the surface look pretty decent here. We're going to start off with the backlog. The backlog came in a little bit light, 6,769. That's below what the street was looking for at 6,992 here. But overall, this was a company that did post an increase in sales. It did post an increase in bottom line net income here. And here's its forecast going forward. The company says that for its fiscal fourth quarter, that it does see adjusted home sales gross margin moving higher at about 27.5%. It also sees deliveries coming in at about roughly 3,200 to around 3,375. That would be above what the street was looking for. Also sees revenue coming in higher as well. And on a full year basis, for the full year, it sees EPS coming in at $14.50 to $14.75. That is an increase of its previous forecast of about $14 a share. Scarlett.
All right. And of course, Toll Brothers right now gaining about 2% in after-hours trading. Let's bring in Drew Redding of Bloomberg Intelligence to give us a little more insight into these numbers. We know, Drew, that D.R. Horton came out with results in which its orders, kind of an indicator of future revenue, did miss analyst estimates even as its earnings beat. What do these numbers from Toll Brothers look like to you?
Yeah, thanks for having me. So when builders report, the number that we typically focus on is that order growth number. Consensus was looking for about 24%. Toll came in at 11%. What's interesting this quarter, though, and you mentioned it with D.R. Horton as well as a handful of other builders, is that in this case, we think that's a backward-looking number because you have to remember in May and June, we had mortgage rates which were 7.5% and remained at 7% up until July. Right now, we're looking at a 30-year mortgage rate at about 6.5%. So this time, more important than the order number is going to be what Toll Brothers says during the call related to deposits and demand trends in July, which look like they were a lot stronger.
I thought it was interesting here, Drew, though, that we did see the cancellation rate in the most recent quarter go down here. What's your general sense right now when it comes to the orders coming in and whether the customers are sticking by those orders? Is that something at all investors should be concerned about?
Yeah, if you look over the last several quarters, cancellation rates across the industry have come way down. Toll Brothers in particular has one of the lowest cancellation rates in the history. That's because their buyers are heavily invested in their home. They're expensive homes. They're putting a pretty large cash deposit down, and they're making investments in upgrades and things like that. So you're less likely to see a Toll Brothers buyer walk away from a home, which is what drives their cancellation rate below peers.
All right, Drew Redding helping us break down the numbers that we just got out of Toll Brothers. Drew Redding, of course, analyst over at Bloomberg Intelligence. Revenue in the quarter up about 1.5%. And as he talked about here, those net signed contracts coming in up 11%. There is a lot of concern here about the health of the housing market and how, well, maybe that drop in interest rates might give it a boost. Daryl Fairweather tracks this as the chief economist over at Redfin, and pleased to say that she joins us right now. All right, Daryl, I am curious here about a catalyst for home buying because there's been so much talk about interest rates coming down, and we have seen some movement on mortgage rates. But then I was taking a look at home prices, and at least on an aggregate basis, they really haven't moved much. So, yeah, you might be able to afford a little bit more home because of the drop in rates, but you're not necessarily paying less on the sticker price.
Yes, that's true. Prices have remained resilient, and that's because supply is down as well as demand. Supply is down because existing homeowners really have no reason to sell right now. They still have those 3% fixed rate mortgages that they got during the pandemic, and it takes a lot for them to give that up. But this movement down in mortgage rates should encourage a bit more of them to sell. They're likely going to buy again, though, as mortgage rates are the motivating factor. So it's probably not going to reduce demand in any way or balance the market. It's probably just going to be a lot more demand still relative to supply going into next year.
When do we have to wait to see if there is a meaningful uptick in purchase and selling activity for that matter? I know seasonally, usually spring, at least here in the U.S., seems to be the hot spot for home buying. But is it possible we could see something prior to that?
Yes, I think we will start to see people jumping back into the market in fall and winter. The savvier buyers know that as mortgage rates fall, there's going to be more competition in the spring, and that will lead to more bidding wars and higher prices. The people who are trying to time the market are probably going to start looking even now in the fall and into the winter to get ahead of the herd.
Daryl, I'm curious to hear from you as an economist whether the lower broker fees, we know that the 6% lock that brokers had on commissions is no longer in place, even as they will still get paid a commission, whether that's going to have an impact on transactions, on the volume of home sales.
Yeah, so we've already measured in our data that commissions are coming down in anticipation of the law change, and then the law change actually happened. So we'll probably see that continue to be. What happens is that commissions start to come down, or at least buyers get more of what they want out of the relationship with their buyer's agent. But anytime transaction costs go down, whether that's lower commissions or lower taxes, we tend to see more purchases. So I do think it will facilitate more home sales. There might be a bit of a rough patch while people try to figure out how these laws work exactly. But once there are norms established, I think we actually could see more activity because of it.
And of course, we have the DNC taking place right now. Kamala Harris will be taking the stage on Thursday night, but she's already given us a preview of the economic policies that she's championing, including $25 in assistance to first-time buyers, for the down payment, and increasing new construction by 3 million homes. Do either of these proposals move the needle in any meaningful way for you?
So I think a lot of buyers are probably paying attention to that $25,000 assistance for first-time home buyers. That's what I saw got the standing ovation during her speech. But that's not going to be effective unless we also get those additional homes that she is promising, or at least putting in her campaign promises. I think that we're going to see what actually ends up in any final policy. It's going to depend on what Congress ends up passing and what HUD implements. But for anything to be successful in her plan, I think that addressing the supply shortage should be the first priority. I think that adding in the demand assistance makes sense if you're going to go big on supply, because that gives assurances to builders that the demand will be there. And it also means that existing homeowners don't need to worry about the new construction competing with their home when they go to sell. There should be more buyers if they're getting that assistance. So overall, I think it is a comprehensive plan. I hope that the supply side stays in it until the very end.
Any sense here of how you sort of goose that here? Because, I mean, we talk to these home builders all the time. I mean, they pretty much have these long-term plans kind of in place. So what actually gets them to shift into higher gear based on whatever the administration or the government wants them to do?
Well, I think it's just about changing the profit motive. So if you have these incentives in place for home buyers, if you have tax incentives for builders, and you also make it easier for them to build, for them to get their projects approved more quickly, for the zoning to be more favorable for first-time home buyers, I think the market naturally reacts to that. Because at the end of the day, the builders are just trying to get to a place that pencils. So if the government can make it pencil better for affordable housing, I think that will show up.
All right, good stuff. Daryl Fairweather, always a pleasure speaking with you. Daryl is chief economist over at Redfin. Let's just take a glimpse at how markets closed on the day, because...
Just a glimpse?
Yeah, just a glimpse, because at the end of the day, we did not extend this long winning streak, right?
Yeah.
It ended at 8 days. The S&P 500 dipped lower by 0.1%. The Russell 2000 falling even more. So I guess that small cap rotation, at least for today, definitely not taking place. Its gains have outstripped the S&P 500, at least recently. So that makes sense.
Yeah, it's seeing a bit of a drop in yields there. I thought it was interesting to see that 2-year drift back below the 4% level, because that seems to be the parlor game right now. A lot of people aren't really buying into this idea that we're going to see a meaningful drop in yields just this soon, even if we do get a cut in September by the Fed.
Well, the next catalyst is the BLS revision of jobs tomorrow.
The revisions?
Yes,
okay.
at 10 a.m. And then, of course, Jay Powell's speech on Friday.
Okay, all right. Are we going to get together at 10 a.m. as a group and just have a little party or something?
Yeah, sure. Yeah. We'll do it. This is The Close on Bloomberg. Fans of the popular morning radio show The Breakfast Club know that co-host Leonard McKelvey, better known as Charlamagne Tha God, likes to dip his toes into various sectors, whether that's writing a New York Times bestseller or serving as ambassador for the food bank for New York City. Well, now he has expanded to artificial intelligence by investing in AI company Meet Kai, where he will also be a strategic advisor to help the company drive growth and engagement for content creation. I'm pleased to say here in studio for more on this is TV and radio personality Charlamagne Tha God. and Peter John Alexander, Chief Business Officer of Meet Kai. Welcome, gentlemen.
Thank you for having us.
Thank you for having us.
I got to start with you, Charlamagne, because Meet Kai bills itself as an immersive AI company. What have you seen from your perch in traditional media, in radio, that gets you excited about offering your content on Meet Kai's virtual world?
Well, for me, I felt like it was the next level of what the interview experience will be. Like right now, somebody's watching this on television, but imagine if you could actually be in the room, as a part of a VR experience as we're, having this conversation. Or even, with Breakfast Club, we've been around for almost 15 years. So when you think about the catalog of back interviews that people like, whether it's the Soulja Boy or Birdman or whatever it is, any of those conversations, you can put yourself in the room of those conversations. And I just feel like, that's where social media is going, to have that virtual reality experience of actually being next to the person that you're watching instead of just watching them.
Right. It's a whole new way of experiencing it. So, Peter John, if this is the metaverse, and that's kind of what Charlamagne was describing, how is it similar to or different than what Mark Zuckerberg has been building out and, frankly, not making a lot of money on?
I think Meta and what Mark has been focusing on is the hardware aspect, which is extremely difficult. And what they've been able to accomplish since they've started is truly groundbreaking with Oculus. Apple obviously stepped into the ring as well. And to Charlamagne's point, we've been really focusing on software and how that changes. When we met about a year ago, we talked about what the future of social entertainment is, and we believe this is one aspect. And using our immersive platform as well as our intelligence platform, the convergence of AI and these immersive experiences is what that future will be.
I mean, I like what Charlamagne was talking about with regards to maybe being kind of like the fly on the wall as he's doing these interviews and stuff here. But explain to me, like, how, as a user, how I would access. Am I going to need like a VR type of device, or is it something that can maybe be done just on a regular phone or a regular computer screen?
So great question. Yeah. What's great about our platform and what we've really focused on is mass user adoption. So being able to be in the browser, being device agnostic. So being on your phone, being on your computer, being on your tablet, being in a VR headset, working anywhere is what matters. So if you can bring the best in class experience with unbelievable visual fidelity and anywhere, it's going to get the most people there to experience what we're trying to build.
Sure. So Charlamagne, though, is something like this, though, I mean, let's just use your show as an example. Is this like the kind of thing where, like, I would even be able, as a user, maybe even ask a question or somehow interact with either you or your guests while you're doing the interview, or is that not how it's going to work?
Yeah, absolutely. Yeah. Because it's like, when you see the live streams that people have now, like Breakfast Club goes live now. Like we'll go live on YouTube or Instagram Live, and you're able to ask those same type of questions there. So it's the same thing.
Okay.
So this is your first foray into AI. I'm wondering what kind of audiences you think being accessible on Meet Kai will allow you to spread your brand or allow your brand to reach out to that you don't already through your syndicated radio show?
Well, I think nowadays, remember back in the day they would say if you build it, they will come. Nowadays you have to meet people where they are. So everybody's going to be in these spaces anyway, so we might as well meet them where they are now.
And of course, part of the value proposition of someone like Charlamagne involved in Meet Kai is the kinds of creators and influencers that he can bring to your platform. Can you give me a better idea of what you're looking for from that end?
Yeah, not only that, and relationships, and we've talked a lot about that, but the wealth of knowledge that he has for being in this industry for decades. And his approach to what we're building is going to be instrumental as it relates to our success. So we've talked a lot about, the people that he's interested in bringing to the platform, and I can let him speak to that. But we've worked with some really big names, right? From the NBPA to BYD. There's new worlds coming online that are focused solely on the consumer end, from the Detroit Pistons to the Pro Football Hall of Fame to Florida State, mixing AI and immersive for the future of education. And then we also have, as I talked about, that convergence is pure play AI that will power these in immersive opportunities that Charlamagne was saying, being able to talk to someone regardless if they're human or not. One of those platforms that's really exciting that's built off of our AI is Ask ROI, which goes live today. So built on Functionary and our family of models here at Meet Kai.
So what are you looking to bring, Charlamagne, like when you talk about the types of additional guests and just really the type of people that are going to be platformed on this?
Everything, from podcasts to, comedy shows, the live podcast aspect is something that really intrigues me because, we all tune into our favorite podcast every week. I have a podcast network called the Black Effect Podcast Network, but imagine if instead of just, watching it on YouTube, you can be a part like you said, a fly on the wall of the actual show every week.
Yeah, and I'm all in on all these. Did you see the Call Your Daddy girl got like $100 million?
Oh my God, $165 million.
Are you ready to renegotiate your contract?
Also, too, another good experience is the audiobooks. right? Because, you know, we all like to listen to audiobooks nowadays, but imagine if you could just sit there and, like, you know, sit at the feet of your favorite author as they're actually performing their audiobook in front of you. I just think that makes the whole experience, you know, of listening to audiobooks better.
I am curious how you and Peter John hooked up. Did you approach him because of the product, or did he reach out to you because of your experience in media and all the business ventures that you had?
Man, some things are just God. Like, I was in, we was in Cannes. Cannes last year, and I was just sitting around at an iHeart party, and you know,
as one does.
And him and James approached me, and you know, they told me about the AI thing, and I was just having a conversation about these visions that I've been having about what I'm talking about now, and they were like, "We're already doing that." So it was just kind of a natural collaboration.
How much AI do you dabble in right now?
Not much. ChatGPT is about as far as I've been going, and now Mikai,
And in terms of timeline, Peter John, what are we looking at before we start to see Charlamagne on Mikai's various platforms?
So I think very soon. What's special about our platform and what we've been able to build is how fast we come to market. Where traditionally I think people approach building these experiences as video games, and I don't think that's the right way to do it. We focus on, you know, using AI at every turn to make these experiences faster and better in every way, and that allows us to kind of have development times that are days and weeks as opposed to months and years. So I think we've been talking about the vision of what's to come, and I think you'll see some exciting things very soon.
Just one final quick question, Charlamagne. Like, when we talk about, like, sort of the future of these shows here, so do you see a vision where maybe these shows won't be just on radio, or even on radio at all, or even on TV, that maybe they will end up on sort of a Meet Kai type of platform, just like that?
They're that way now. Like, none of these shows exist in one space anymore. Like I said, you know, you build it, people aren't just going to come to you. You literally have to meet people where they are. So you, for example, Breakfast Club, we're on the radio, but we also come out as a daily podcast every day, and we also put out clips on social media, and we're on YouTube. So that's why we have the audience we have. You're talking about, you know, 8 million monthly listeners on terrestrial radio, but then 15 to 20 million downloads a month on the podcast, then the YouTube, then the social media. So you have to exist in all of these spaces nowadays. You can't, you take one piece of content and serve it up 20 different places.
All right, and you got a lot of content. Have you talked to Birdman lately?
No.
No. All right, we'll leave it there. Charlamagne Tha God and Peter John Alexander. Charlamagne investing here in Meet Kai, a new virtual world platform, if you will, that maybe is the future of media, Scarlett. Maybe we should look into this.
I think our kids will look into this.
All right, stick with us. A lot more coming up on the close. We're going to set you up for the potential market-moving events over the next 24 hours. This is Bloomberg. All right, let's push ahead here and look at some of the potential market-moving events over the next 24 hours, and that includes some big earnings out of the retail companies tomorrow morning.
Target, Macy's, TJX, and if Walmart was any indication, people are looking for value, and that certainly benefits a company like TJX, maybe to some extent Target, but less so for something like Macy's.
And then after market here, we're going to get a slew of folks in the software and tech space. Snowflake scheduled to report here, Zoom Video, which is still going. And Synopsys.
And Synopsys, you know, we're just joking about what kind of company is Synopsys. It's yet another enterprise software company. There's a lot of them. Yeah, that's all the rage these days, Scarlett Fu. I mean, we'll see what they do. I am curious more in Snowflake because, I mean, there's been a lot of talk here about their trajectory higher and whether they do have a sort of a longer-term growth strategy and whether they can capitalize off this whole AI boom, as I think everybody wants to do. We get some economic data too tomorrow. We get the weekly mortgage applications.
Right,
and you know, this is a big one. The Bureau of Labor Statistics is going to revise its annual job growth numbers, and we could see a big adjustment.
I feel like this is like the binary event because it's either going to have zero market reaction or the exact opposite. Anyway, the DNC also continues. Former President Obama scheduled to speak tonight. We'll be back tomorrow. This is The Close on Bloomberg.